Tariff volatility is back on Wall Street. President Trump lashing out against China this morning, saying China has violated its agreement with the U.S. Meantime, Treasury Secretary Scott Bessent saying talks with China are, quote, a bit stalled. His comments coming after a federal appeals court offered Trump a temporary reprieve from that ruling that did deem his tariffs illegal. Joining us now to break down where to ride out the trade-induced volatility is Cole Smead. He is CEO of Smead Capital Management, which oversees more than $7 billion in assets under management. Cole, it's great to have you in the studio.
Good to be here.
Thank you for being here. We were just talking about this morning's inflation data indicating that there is a little bit more progress when it comes to prices than we saw in the consumer price index print, but the tariffs still remain a headwind, and that certainly played out in this morning's economic data. How does that impact your investments going forward?
Yeah, you add one more thing. You had consumer confidence hit a low that we saw in 2020, a low that we saw in 2009 and also 2011, okay? And I say that because when you put all these things together, I think it's really incredible how the U.S. economy has functioned despite high levels of uncertainty, particularly for business spending, okay? If you go talk to business owners right now, they're pretty scared about the whole tariff situation. I was at an event, someone was, makes guitars for a living, and they were just, freaking out. Go talk to people on Main Street, and they're not like at soccer practice being like, what's going on today with tariffs? And I say that because it shows you the difference between business.
Are they not, though? Consumer sentiment numbers have been plummeting.
In New York, yes. But in Main Street America, no. That's the big difference.
What is your evidence of that? Are you talking to people across America?
I just mean if you just go talk to people day to day. Like I run into investors, I run into people in the media business, and I run into people in business owners. And again, that's a big idea for them, especially if you import or export your goods. Okay. When it comes to day to day beyond that, that's just not showing up. And I'll give you a picture of this. What are we spending in deficit? It's 7%. We normally only spend that, if you look back at the history, we did it, big deficit in World War I, big deficit in World War II, but we quickly tightened up our budget to get back to a much lower level of deficit or none at all. We have not tightened our belt at all. And what that's doing is it's providing this huge economic stabilizer and buffer in the economy. So this is a lot of uncertainty to pour onto the economy in, say, a 60-day stretch, and yet at the same time, the economy's not falling off, consumer spending is not falling off. Why not? And the answer is because it's really tough to stop an economy when you're spending this much in deficit. And no one's really saying that, by the way.
Well, to the very report that you just mentioned in the consumer confidence, they actually wrote in and said that tariffs are still top of mind for consumers' minds. That was in the write-in responses, the first mention in that stanza as well.
Correct.
So to say that they're not talking about it is incorrect based on that same report.
But you look at the spending, though, isn't going negative.
What you're saying is the difference between the soft and the hard data, it sounds
Correct.
like.
When also that soft data is bad data to invest based on. So at low points in the data, what should you expect? That the economy is going to pick up. Because I said 9, 11, 20, and today. And so I would expect the economy picks up because when those people survey, they're telling you, like the weatherman, hey, it's sunny today. And it's like, well, I already know that. They're telling you that there's uncertainty. But the reality is you can't invest based on that. I think we're going to wake up in 6 to 12 months. We're going to find out is we did not slow the U.S. economy because until we slow our deficit spending, you can't slow it.
What is the investment thesis when you have what now is more commonly known as the kind of the tariff taco trade as well here, where the acronym Trump always chickens out, which he is asked about. And Wall Street is also trying to wrap their minds around because even in a note from UBS, they acknowledge that this changes every single day here, and we're seeing a lot more of these notes from major institutions saying at the time of writing, this is happening, but this could all change in a moment's notice on a Truth Social post.
The thing that doesn't make any sense to me is right now we're talking, back to the fiscal deficit. We're watching the 10-year and the 30-year move higher. Okay, and all the big banks will talk about, gosh, this is really, this is worrying. We could have a big move in the cost of capital for our government. And then you pivot over the equity market, and the equity market's like, who cares, bro? Okay, in other words, why are we so worried about certain problems in certain parts of the asset markets? And then you pivot to elsewhere. So that's a part that doesn't make any sense to me. Why are we worried about treasury costs and kind of the effects that tariffs will have on the economy and thus those treasury costs? Well, at the same time, if you look at stock valuations, not a care. There's not a problem in sight when you look at the valuations of the S&P 500. Particularly, here's the interesting part, there is no history that industries that use major CapEx ever succeed in the stock market either. And it just so happens that the biggest US companies, the hyperscalers as they call them, is doing more CapEx than any point in US history. And it didn't work for the railroads. It took about 70 years. It didn't work for the oil companies in the 2010s either doing that. And supposedly we've solved that issue because it's American exceptionalism that we know that isn't as exceptional as we once thought it was.
And it's certainly in question. Talk to me about how that informs what you've been doing with capital. What have you been doing over the course of the month of April?
Yeah.
I noticed this morning we're up 4% since April 2nd. So it seems like investors have moved on, but what sectors are you putting more capital?
Yeah, so back to the strength of the economy. I think people, anything economically sensitive, people have really given up on, okay? Let me give you an example. We own Mall REIT, so we own Macerich, for example. Right. That's a business that earlier this year was trading at over $20 a share. You wake up and it's at 14, down 40% in a very short period. What's happened as their data's come out and the leasing spreads are showing up, what are we finding out? That since no one's built malls for years, and we're not going to build any malls for years to come, Class A or high-end malls have nice leasing spreads. Why? If you're a high-end retailer, premium, luxury, whatever that may be, where else are you going to go to attract customers outside of digital clicks online? And so what we're seeing is that some economically sensitive businesses that have good economics are just being left out there. Ulta reported yesterday, for example. We own Ulta. That's an addictive legal drug. I have teenage daughters. I've learned that it's a generational legal drug. And so I just point that out because that's the spaces in some of the retailing space. Use the news this morning on OPEC Plus, okay? Oil is right in the crosshairs of the economic sensitive conversation. Two parts. One, what is OPEC doing? And then secondly, what are tariffs doing to the economy and what's the economy going to do? Economic sensitivity is really cheap in the stock market. It just is that's not really dominating the market cap of the S&P today.
Just quickly while we have you here, I think, John, the stat was best May since 1990 we might be looking at closing out here, depending upon where the market closes here on the day. With that in mind, what do you do in June if you're an investor trying to figure out, okay, if my checklist has already seen this massive rebound in May off of some of the pullback that we'd seen during April and the rebound there that ensued as well, what holds for the post, what would typically be the sell in May and go away type of period?
Here's your cold water, okay? When the tech bubble peaked in March of 2000, we almost got back to that high 5 months later. It didn't stop it from being a nasty bear market, though. I think that's the reality of the situation. I think this is kind of a degenerate market where the dumber you are, the more foolish you are, the more money you've been making. And that's got to end because ultimately the stock market was not formed to get everyone rich. It was created to move money from those that are impatient to those that are patient. And I think we saw in April that not everyone was as patient as we thought they were.
Cool. Good to see you here this morning. Thanks so much for taking the time in studio.
Thank you.